Hi, you're watching Investor Insights, and today, happy birthday Australia. Now, seriously, I couldn't think of a better topic to talk about than Australia, the lucky country. That statement is so true. This is a beautiful nation, and it's basically amongst the best places to live on the planet. You have the right to do whatever you want, just like America, the land of the free, with the one exception that you really have no choice when it comes to voting. It's compulsory. That in itself is an infringement of freedom, because some people, such as myself, don't really want to vote, not because we're lazy, but because I believe that whoever I vote for, whatever conditions happen, however things work out, I'm still screwed. So what's the point? But anyway, talking about Australia, things look eerily calm at the moment. Stock market's good, 5.5 year high. We've got real estate which is at an all-time high. People seem happy, and there's a lot of high fives and backslapping in the investment community. But as usual, you have to look beneath the surface. And the question that is posed today to everyone is this really the lucky country? How good are things in Australia at the moment? Well, let's look at numbers. The government is very proud to say that this is a country which has not been in recession for a good part of over 20 years. But against popular consensus, I believe that statement is a lot of bull dust, because it all comes down to contrived CPI numbers. In the very last GDP print, which was only released last week, it turns out that we're not growing that much after all, if we're growing at all. Now, I've attached all the statistics that I'm going to talk about today within the description box, so have a quick look and you can make up your own mind. Now, the GDP advance was 0.6%, and even according to government numbers, the rate of real growth was -1%. So adjusted even for government contrived inflation numbers, you're looking at a real contraction, not expansion as you would be led to believe. So if the government now can't even hide the fact that we're contracting, means that the real economy, so the one that Main Street lives in, it's grinding to a halt, and in fact it's reversing. Every sector aside from mining, which in itself is contracting now, is suffering. We are in a recession, a real recession, and to be quite honest, you've been in one for the best part of at least half a dozen years. It's not because of the GFC, it's just that the inflation numbers have been contrived or manipulated. Well, with the numbers that we look at, like GDP, which in itself is subject to manipulation anyway, it's pretty easy to paint a picture of an economy which is in trouble. And if you then look at the employment situation, which, as you know, I regard as the most important, Australia this week announced that we actually lost 22,000 jobs. And that should be a red flag, big warning bells being sounded all over the place, because the employment situation is worsening. Sure, the unemployment rate is still 5.8%, and it's still amongst the best in the world. We're below our long-term average of 6.93%, but that, as I always talk about, is stated unemployment. We've got a very low labour participation rate of about 65%, but at the same time, we are looking at real unemployment of closer to 11%. you can only shrug your shoulders and somehow wake up to the reality that if the domestic output is contracting and the employment situation is deteriorating, well, that signals to something which is going to blow up to be much worse down the track. The government last November had to raise its debt ceiling for the first time in God knows how many years. That's a sign that again, the public sector is deteriorating and government revenues are falling short of expectations. The Labor government for the past few years has been trying to get the economy into surplus, and it's been missing out by about $1 billion at a time. So we were at a near balanced budget position until about March, when that $1 billion deficit turned into 18, and by June that was 33 billion, and now God knows how much is it. So a government is only as rich as the people it taxes, and Main Street is just about as broke as Main Street in America, where 1/3 of people are dependent on food stamps to just survive. It's not quite that bad down here because there's a lot of government handouts, but as I said, the government's getting more and more broke by the day. When it comes to looking at the actual inflation data, the government does a pretty good job of hiding it. But this week, the data that was released showed that inflation is now at an annualized rate of 2.7%, which is getting close to the RBA's threshold of hiking rates. Now that 2.7%, it doesn't matter how they picture it, I still believe it's baloney. Because anybody in the real world out there, anybody in this beautiful country who goes out and buys petrol, buys food, pays rent, pays for electricity, pays for phone bills and the like, will easily tell you that those prices are not increasing at a rate of 2.7% per year. Electricity prices just on average the past 5 years have averaged 4.5%. Petrol prices at this time last year was $1.25 a litre, and at this point in time you're looking at prices are around the $1.55 to $1.60 mark, depending on what day of the week you pay for it. So what the real inflation number is anybody's guess, but if you look at average prices that people pay, you'd be looking at real CPI numbers of somewhere between 5 to 10%. Now when you look at the GDP data release last week of 0.6% annual, 0.6% for the quarter, and the inflation rate for that quarter was 0.6%, then you're looking at a real GDP print of flatline. But if you then take a more realistic CPI figure of 5%, then you're looking at a contraction of closer to 5%. If you're then at the higher range of CPI, 10%, then you're seriously looking at possibly a contraction of 7.5 to 10% if GDP growth was set 2.7% as they said. But regardless of whichever way you look at it, Main Street is not happy. Everywhere you go, there are shop closures everywhere. Some big names like the body shops, they've practically all disappeared. You've got sales all over the place, but yet people aren't really buying. Consumer credit is not rising because although the bank offers it, it's not being taken up. And it simply comes down to one thing: housing. Our economy is now purely putting up all its hopes on housing in a huge way. Our housing bubble is worse than the one in America. Despite there being no predatory lending and no adjustable rate mortgages with teaser rates, our bubble is gigantic. The banks are making a squillion out of it, but this is not going to last for very long. rather than get into the topic of housing for too long, that will be the subject of one of the next few videos that I'm making. But when your whole economy now is resting on the growth in housing, so anything associated with it, like construction, logistics, and materials, also things like the actual sales, so the real estate agents and the banking sector, you're just playing with fire. Because for a country to be productive, that's the word productive, you actually got to produce stuff. And housing is going to be only so much limited, because one has to realize that the prices are due to very loose monetary policy. The RBA has cut down to basically an all-time high, all-time low rate of interest. So people have just piled in. Money follows the path of least resistance, just like water flows down the stream rather than up the stream. So in this case, you've seen the housing market actually go up 10% last year on average. You've got Sydney median house price at $720,000, an all-time high. In fact, Sydney real estate prices are the 4th most expensive in the world, Melbourne being the 5th. So what does that tell you about real estate? As I said, that's just one bubble. The other is in the stock market. I've attached a sector breakdown of the ASX 200, which is our national index. And you can see that the property and financial sector is now over 40% of the ASX 200. Materials, BHP and the like, who were the leaders 4 or 5 years ago, are now at 23% of the index. So when financials are double the next biggest sector of materials, you know that the market is very frothy. There hasn't been one instance in the past, God knows how many years, where the financial sector has exceeded 30% of the index and the market has crashed 30% afterwards. Every single time we crossed 30, the market corrected afterwards in a big way. I'm not talking 5-10%, I'm talking 25 to 30%. And this time we're in uncharted territory, because the financial and property sector has gone over 40% of the total index. So you're looking at 2/5 of a pie chart, which is just the big banks essentially. And if you look at the returns on the bank, and 5 years ago, during the height of the GFC, ANZ was at $11, the CommBank was at 24, now the ANZ's at over 30 and the CommBank's over 75, all with increases in dividends. So had you invested your money in them all those years ago, you would have tripled your money in terms of capital gains, and you would have easily made an extra 100% on just dividends alone. Now that picture is telling you that profits are now 3 or 4 times that of 4 or 5 years ago. But in reality, it isn't. The profits now come purely from mortgages. Thus, this housing bubble. Most of the bank's capital is in assets that are real estate related. So what's going to happen when inflation hits and there's a spike in interest rates? Those banks are going to be sitting on tremendous losses in terms of real estate assets. A lot of people will be foreclosed on because they're maxed out right now, and eventually the market's going to correct when people realize that they have been the biggest fool. There is no such thing as real estate investing right now in Australia. It's all speculating. So when you look at the GDP situation, it's realistically contracting. The employment situation, that's deteriorating. You're looking at the housing market, which is way overheated. You're looking at a stock market which is also way overheated. What more could go wrong? Well, I think that's pretty bad. But then comes the one thing that I always talk about, which shows what kind of an economy your country has, and that is the balance of trade. Now, you're looking at a balance of trade which is getting worse by the minute. Now, that could be due to a falling currency or deteriorating material prices, but essentially you're looking at, I was just looking on that chart, the terms of trade for the September quarter was actually minus 3.3%. So relative to other countries, when we're what we're exporting to what we're importing is actually falling by 3.3% in currency terms. So 5 things, 5 different rates of deterioration, and potentially 5 separate incidents or disasters. Is this really the lucky country? I'll let you decide.